And so we have a simple sketch done based on that we put into the software. We make a 3D model that AI generates. So we don't make that by hand, which many designers are doing. Then we use another AI to do patterns and textures all around this. And so we can iterate through lots of different versions of that. We do some other stuff around shading, but we have a new shoe designed fairly quickly with that method that's much more cost efficient and much faster. So majority of it's AI. We've been currently at 70% for our Explorer slide, 70% generated. We still have the human being involved. We don't want to get rid of the human. I don't think AI would work as well without that, but that's where we're at today.
Why not come out blasting with a performance sneaker? Joe dates back to launching with the running sneaker. Why not follow in his footsteps? No pun intended.
Yeah. Well, if we go to the performance market and the athletic market, there's so many brands there, right? And if you even just look at basketball, you have every big brand today fighting over the next top basketball player. And then the one with the biggest, checkbook usually wins in that situation. It can be very difficult. Well, today the eyeballs have shifted. The youth is looking at TikTok, at YouTube, at, Instagram, and they're watching these influencers that are all lifestyle influencers, whether that's Jake Paul, Mr. Beast, whoever it is. And these people are selling millions of dollars of merch, of hats, of shorts, of hoodies, of everything under the sun, but they never get an opportunity to do footwear. Across the board, you never see shoes on these content creator websites. So we wanted to pioneer a new method using AI design and 3D printing because it would take the time frame down from 18 months to 3 months to make shoes and the cost to pretty much 1/100th of the cost to make an original design from scratch for these individuals. So we wanted to find white space. Joe talks about in his book Shoemaker, white space, and you need to find your own white space. He did that with aerobics, with women's yoga only shoes.
Jane Fonda.
Yeah. And this is ours.
You're essentially creating a shoe business from scratch.
Yeah.
What are the barriers to entry to bringing your vision to life? What are some of the challenges you've been encountering since launching this?
Well, we're a new player in this space. It's a space that has a lot of established individuals, and there's brands that have been around for years. So we have to build our brand identity. We have to create something that people want to be a part of. So our creative director, Ace, recently came up with the slogan, Design by Tomorrow. And we're building our whole brand around this Design by Tomorrow ethos of you can wear the most futuristic and innovative design that you just can't get anywhere else. And that's what Scintillate is all about. And that's kind of how we're going to stand out in this space. We're going to apply new technology. We're going to make footwear a technology product as we go. It's going to keep increasing. There's a lot we can do in that space. And we're going to be a brand that stands for innovation in a category that has a lot of bestsellers that are 50 or 60 years old today.
Can you get the equipment you need to scale up your operations? When I think sneaker manufacturing, by and large, it's all overseas.
Yeah, we would like to be able to produce more and more locally where we go. One of our production partners, Zellerfeld, which is producing our slide today, they're our production partner. They're going to be producing soon in Texas around Q3 this year. So we'll be having localized production for 3D printed slides and our upcoming sneaker. So that's going to really, I think, change a lot for us in this demographic. It's going to enable us to be far faster. I think we'll be one of the only brands that's producing in the United States at that point. And I think we can scale this model to other places so we can avoid, other sorts of taxes and stuff in different countries.
Joe, let me get back to you. Take us through some of the history of why shoes were made overseas and why we have that big manufacturing base. I think back to, you were early on in South Korea decades ago. Why did all the manufacturing not happen in the U.S.?
It's quite a simple answer to that one because we manufactured in the UK and we manufactured for the UK market, and we got to the point where we were very well known. In fact, we probably owned the track and field market in the UK. It was a decision then: do we go to America and then go to a new territory, or do we go into the soccer business? The soccer business, though, was owned by Adidas at that time. Would cost us too much. So I came to America. Okay, it took me a long time. It took me 11 years. I came first of all in 68, got there in 79. That's a long time. But I was having fun and enjoying it. But at that time when running really became a big event with everybody wanted to go out running. And I got picked up by Kmart and an unknown sort of brand, which was Boston Camping. But Kmart, I went to see Kmart, and Kmart said, well, Joe, I want to give you an order for 20,000 pairs of shoes, but it'll have to be at a better price. That's your answer. Better price.
And for those not familiar with what Kmart was, Kmart was a discount retailer in the United States. At one point, it was publicly traded, and then it was owned by Sears Holding, and then Sears Holding went went bust. I used to cover Sears Holding as an analyst, so it's remained remains near and dear to my heart. But Joe, how tough is it to? I'm sure you're watching everything with tariffs and footwear, and how tough is it for companies, whether it's a Nike, a Reebok, Adidas, to move production out of some of these Asian countries after doing it for decades?
It's virtually impossible overnight. It takes a long time to set up anywhere. And unfortunately, it's to find out where can you provide the people, because it is, it needs a lot of people. It's not something you can just turn the switch on. Where Ben is now at 3D printing, that's using a machine, but it's slow. So if you want millions, as we wanted millions of product, you've got to go somewhere where you've got a lot of people who are quite willing to sit.
Just watching everything here
women
into
on the sewing
closing.
machines,
IWM
men
is
on
the
the
weak one for the day. Let's see where we
production
hold up.
line. And
Each
that doesn't happen
sector,
overnight. In
each
fact, in the
ETF has
UK,
pretty
we
much
can't
hit
get people to do that.
their
They won't
average
do it. They've moved
move
on to
throughout a
whatever
summer
different things.
day.
And
So we have
I think the
SPY
States
at
do exactly
about
the
half a
same. So to
percent,
get back to that, you've
tech
got to invent
almost
some
0.8%,
way of being able to make a
and
traditional shoe,
IWM's hitting
make
at
it fast and make
around
it with fewer
0.25.
people.
So it is
And
the
you've got to put
slower one or
robots
the
out there, and we're not
weaker
there
one
yet.
on the day.
You know, they can make cars with robots. At the moment, shoes, they can't do that. And nobody's even thought about that. So maybe where we are now with 3D printing, can we improve the speed of the 3D printers? Can we improve the techniques? So this is why it's so original and so good. And it is that, as Ben said, it's that bit of white space. That, you know, there are certain, I think the apparel business and the footwear business, they're going to be in the Far East for a long time.
Joe, what do you when a footwear retailer moves production from, let's say, China to South Korea or Vietnam, as we're seeing now, does quality take a hit? Are consumers about to get a lesser quality product in this backdrop?
Well, where we have been, and we've been all over Asia, from China through to Vietnam, through to Philippines, and what happens is that the techniques and the people actually go with the machinery. So the people who've really developed the quality go with that, and they move people about quite easily and quite readily. So the quality, we've always found the quality is immaculate. It's brilliant. In fact, when we moved from the UK to Korea, to South Korea, uh, we couldn't believe the quality that we were getting out of South Korea. And then, of course, we've been all over China, you name it. And that's where production is. That type of product is going to come out of Asia for a long time. There are some small, you can go to Portugal, but the volumes are not there. Again, to get the real volume, you've got to have a lot of people. So to get out of Asia, difficult. We need to find new techniques.
All right, hang with me, Joe and Ben. We're going to go off for a quick break. We'll be right back on Opening Bid Unfiltered. Are you ready to master the markets and, dare I say, become a better investor in the process?
IWM close to a new low of day.
Full suite of original podcast content. Whether you're a seasoned investor picking up new trends or you're just
About 10 or so points away from that.
Invaluable market insights and strategies from some of the most influential minds on Wall Street.
Cents, I mean.
For key insights to help boost your portfolio, build your wealth, and make you a successful investor. Join us on yahoofinance.com, the Yahoo Finance app, your favorite streaming platform, and wherever you get your podcasts.
We're now 15 minutes away from power hour. We are at the beginning of these new 15-minute candles.
Welcome back to Opening Bid Unfiltered here at the NASDAQ in Times Square. Having a fun chat with Joe Foster, Reebok founder, and Scintillate CEO Ben Weiss. Ben, you heard Joe talk about it's hard to get labor to make shoes in the UK. You know, as you look out over the next decade, I imagine you have some form of business plan here at Scintillate. Is one of your biggest concerns that you can't get the human beings to make products here in the United States?
I think that like what Joe said about automation is a key point. If we want to bring production back to America or wherever we want to put it, the more automation, the better. So we want to really automate a lot. And the question is if that's possible and just even how much of that is possible. I mean, we've seen other examples in the automotive space that have worked. I mean, there's other things in terms of machinery and making of machinery where you would even have that done. But I mean, I would like to see it happen. I think it'd be amazing if possible. And we would have to figure out a way to do that. We have had conversations around this. We have explored plans of how to do it. It has to make the right sense also financially for us at that point in time. But it could be a massive competitive advantage. I mean, today brands, a lot of them are logos and distributors, and if you're doing production and you can iterate far faster than anybody else, you can test out better ideas quicker, and you don't have to deal with the same, lead times that you're kind of used to. So we would like to be able to figure out something like that. I think it would be a massive breakthrough in this category.
How much are your slides now?
Currently, they're at 150, and shortly, the version 2 will be debuting at 120.
Once you start making more product in the U.S., I mean, all the adages or the thought is more products made in the U.S., the price is going to double for footwear. Is that true?
I think we have to continue to just explore that segment and figure out like every single piece of the supply chain there. When it comes to 3D printing, it's actually going to go down in cost because it's just filament and then the printers. And there's a substantial investment being done in Texas now to have a much larger facility with tens of thousands of square feet that will have many more printers than our current capacity. So that's going to reduce price a lot. So it really just depends on what goes into your supply chain. I mean, if you have a lot of equipment costs, you have to import all this equipment, and then you have other things you have to be able to bring in. You don't have the labor here. That's another thing. But with 3D printing, we don't need that same labor. So I think it's a great way to be able to build in America and to build something here in a much quicker manner than what it would take to establish a traditional production line from overseas in the United States.
Joe, you mentioned it's tough to get folks to want to make sneakers in the UK or footwear, or I imagine even apparel. What has to change? Is it more than just paying them more? Is there other incentives they need to take these jobs?
I don't think people want to sit down now in front of a machine for a shift of 4 hours or maybe 2 shifts of 4 hours. I don't think people want that. I think now we have social media. Everybody sees themselves in something different. They want to work for themselves. A lot of people want to be self-employed and do
New
do
low
something
day
different.
here on IWM, dragging the
think
rest
that,
of the market down
we
with
want to
it.
change
Let's see if it
people
holds
back
up, if it can
to being
bounce.
able to work on a production line. It doesn't seem to me that that's really possible. We've got to find a way of making it differently. And if we can automate it, then fine. But some of these So footwear products are quite complicated. You know, there can be maybe 100 pieces just to a pair of shoes. All different pieces come together to make a different product, especially the more specific, let's say, athletic shoes that require to be very light, require to be very flexible, and if you're running on the road, you need it to be very comfortable and cushioned. And there's all different pieces that go together. So I don't know. It just is something that is out there at the moment in Asia, and that's so big, and they make so many. I would imagine that someone like Nike probably produce 20 million pairs a month, a lot of shoes a month, and that's just one company. Put them all together, I mean, 100 million pairs every month. How do you manage to move that sort of capacity?
Yeah.
Where can you take it? And that's the difficulty.
I'm interested in your. So Nike, of course, is this big behemoth in the industry, but over the past, let's say, 2 years,
Order filled.
we've seen a whole bunch of upstarts come, whether it's Hoka in running, On Running and trail and running shoes. Even Brooks is starting to have even more of a moment in running sneakers. What's your assessment of the landscape, and how long do you think it will take? Does Nike ever get back its dominance, I guess?
It all depends. You never know if they take their eye off the ball, or if they just miss something, or somebody comes in with something. You mentioned On. They came in with a different look, and that different look, that's fascinating. People just want to try it, and I think the main thing that's happened is that now footwear is all footwear now is influenced by sport. It's that influence, you can see it wherever, whether the slides, whether the sneakers, whatever. People now just wear those all the time, and this influence has even gone into apparel. And even now, the elite brands, they're now having this sneaker influence. So that is what's changed. Plus, the other big thing that's changed is when we started many years ago, sports stores were just small, run by an ex-athlete, and he would stock everything, bits and pieces. Now we're down to probably 6, maybe 7 major retailers and a few others, but we're down to that now. Those retailers, they're bigger than the manufacturers now. Some of these really big, they're massive, and so that has changed an awful lot. And this is just continuing to move on. We're seeing now clogs and slides. We're seeing more of those, because so this influence is going. I wouldn't say away from sneakers, but it's more including clogs and slides. So people want more comfortable shoes, and that's what they want to wear. So we're just going dress shoes. Well, you hardly see dress shoes. Even
Yeah, no one wants to wear dress shoes. Nobody wants to polish the things anymore, Joe. We can't even get people to polish them. Talk about labor shortage. Who wants to polish your own shoes? What do you think about that? I want to get back to Ben real quick on something else. But what do you think about that Dick's Sporting Goods buying Foot Locker? When I saw that deal cross, I'm like, wow, you got to be kidding me here.
Yeah, I was quite amazed about that one. You could have probably believed it the other way around, but there we go.
Yeah.
So whether they will keep them as separate distribution, I think they will do. I don't think they'll convert all the stores into Dick's Sporting Goods. I don't think that will happen.
In the last couple minutes of the program, we usually do a hot take segment. Since I have 2 guests, I'm going to go for 2 quick, short hot takes. Joe, over to you first. I'm sure you saw the documentary on Reebok. Shaquille O'Neal now in the mix. Reebok getting big on basketball. Do you think Reebok will be back in the basketball category like it was, in the early to mid 90s?
Yes. Short answer is yes. I do. I think that Shaq is really into this, and he really wants it to happen. He is part of ABG, so they really are working hard on this. Just in the same way in Europe, we're coming back into football or soccer, as it's known. So yes, there's no reason why not, and we have a history. Everyone I talk to, maybe even yourself, country, I remember the pump.
Oh, my mom would never buy me the pump, Joe, ever. It was just too much money. I mean, I didn't come from much. She just wouldn't buy me the damn pump. I was the only one to not have pump. I had a pair of Voits. You remember those, Joe? They were like
Yes.
they were like $30 and a pair of Patrick Ewing high tops. I mean, they were freaking awful. They were just awful. Don't even get me going, Joe. You just can't.
That's the story I get from everybody.
Yeah, it's just.
I had to go out and get a job.
Yeah, it was absolutely rough. And my hot take question for you, Ben, is this: what have you learned from a guy like Joe Foster?
I mean, there's so many things, but to put it into something pretty condensed, persistence. I mean, Joe Smith,
5 minutes left
10
on
plus
these
years
15-minute
trying to
candles
find
we're
a
watching, and that's
partner,
5
getting
minutes
bought
until
into the
power
US.
hour.
He kept going through different people. He would go to this like trade show and, pitch people and try to get someone to be his partner. And eventually he found Paul Fireman and, took off and did really well. And he didn't give up. I mean, who knows if we would have even known of Reebok today if Joe didn't spend year after year after year going out to this convention and trying to make it happen. So this is going to take time. I don't know if it will take that long. We were in the age of the internet with social media, but we're going to continue to build and just be persistent and never give up.
All right, well, keep hustling, man. Good to see you guys. Wishing you luck on the new venture. Ben Weiss, CEO of Scintillate, and Joe Foster, Reebok founder. Good to see you guys. Looking forward to staying in touch. And that's it for the latest episode of the Opening Bid Unfiltered podcast here at the NASDAQ in Times Square. Continue to hit us with all those likes on the social media platforms and also YouTube. Appreciate all the feedback. That's how I and we get better. Talk to you soon. Are you ready to master the markets and, dare I say, become a better investor in the process? Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor picking up new trends or you're just starting your financial journey, we offer invaluable market insights and strategies from some of the most influential minds on Wall Street and the boardroom. We're also teaming with some of the biggest rising stars in the financial community for key insights to help boost your portfolio, build your wealth, and make you a successful investor. Welcome to the Opening Bid Unfiltered podcast.
Welcome to Stocks in Translation. Welcome to Financial Freestyle.
Welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk.
Welcome to the big idea.
Behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, your favorite streaming platform, and wherever you get your podcasts. Are you ready to master the markets and, dare I say, become a better investor in the process? Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor picking up new trends or you're just starting your financial journey, we offer invaluable market insights and strategies from some of the most influential minds on Wall Street and the boardroom for key insights to help boost your portfolio, build your wealth, and make you a successful investor. Join us on yahoofinance.com, the Yahoo Finance app, your favorite streaming platform, and wherever you get your podcasts.
Hello and welcome to Market Domination.
We are now in Power Hour.
Live from our NYC headquarters. Investors locked into tariff headlines as talks between the EU and U.S. intensify. There's still an hour to go until the closing bell, and right now all indices pointing higher, with both the S&P 500 and the NASDAQ sailing fresh all-time highs during intraday trading. Let's welcome in now. We've got Kevin Mon, Chief Investment Officer at Hennigan & Walsh, our Washington correspondent Ben Werschel, and markets reporter Josh Schaefer, who are here to break down all the action. Ben, we're going to start with you, my friend. It does appear like President Trump, Ben, still playing kind of hardball when it comes to that self-imposed August 1st deadline. Ben, walk us through the latest.
Yeah, so the theme of the day, I think, on the trade, and there's all these different trade fronts, but I think a theme of the day to watch is a bunch of different countries and blocs kind of essentially publicly setting plans for what the world looks like if there is no deal by this August 1st deadline that we're all focused on. And this comes, as you mentioned, with President Trump and his team setting sort of hard conditions for a deal. Europe is the central one, as you mentioned. What we got from them is a series of reports from Brussels in recent hours, basically about what Europe would do if they don't have a deal by August 1st. That could include retaliatory tariffs. It could also include what are called anti-coercion instruments, which would be a major escalation and would essentially allow the EU to restrict U.S. trade. We're seeing it on other fronts as well. Brazil and India are two, where what we've seen is leaders in those countries talking to their local media, essentially to lay the groundwork of how there might not be a deal on this August 1st deadline. India was here in Washington this past weekend.
Russell 2000
about a mini deal, but with an announcement date
now
there
red on the day,
in
so
September,
it's red,
October. So not August 1st. Same with Brazil, who were facing 50% tariffs, and they saw some of their leaders giving interviews there saying this may not be done by then, and we may have to sort of deal with this 50% tariff, at least for the short term. You're hearing a lot of this from the White House side too as well. Treasury Secretary Scott Bessent was on CNBC today talking about how they're in no rush and they're looking for quality deals. So I feel like I'm on every time talking about how it's kind of hard to know with these deadlines, but we're sort of seeing what this August 1st deadline is going to actually be and what it may not be as a lot of these continue on.
And Ben, switching gears a moment, but staying with all things Trump here, White House watching the dollar drop, Ben, and maybe debating whether that's a good thing. I know you've been following that story as well. Ben, what could it mean for Trump's agenda?
For sure. So a notable feature of Trump's first 6 months, which just ended yesterday, is that the U.S. dollar has dropped almost 10% over that span from early January. And what that comes is Trump often reiterates that he wants a stronger dollar. He talked about it just last week. He said he would never, ever let the dollar slide. But there is a kind of recognition among some corners of Trump's cabinet, this is reflective of a debate there, that there are at least some benefits to a declining dollar, especially on this trade front. Commerce Secretary Howard Lutnick was pressed this weekend on CBS about rising consumer prices and talked about how the declining dollar could soften that some. The overall message here from the White House, which a White House official reiterated to me just recently, is that the administration's position is a stronger dollar, a bigger dollar, but there are key factions in Trump's economic team that are open to a weaker dollar to solve a lot of these issues and kind of soften some of the impacts. So how that plays out in the coming months remains to be seen, but the dollar is down significantly over these 6 months.
Kevin, we'd love to bring you in here as well, get your take on what you're seeing out of D.C. What do you make of it?
I believe at some point we need to see an actual announcement of an actual trade agreement. We keep getting these teases that these trade agreements are coming. And I think the market has largely shrugged off the threat of these trade agreements right now, believing that the tariffs are going to be much less severe than what we originally anticipated. So we need to see an announcement, particularly as it relates to the European Union, one of our largest trading partners.
Can I get your take, Kevin, quickly on what Ben was talking about there, which is a subject we talk about a lot, the softer dollar. Yeah. How do you see that rippling through earnings season? That should be, Kevin, a tailwind for the multinationals.
It should certainly be a tailwind for the multinationals going forward. I think if we do see a weaker dollar, if the Fed does cut 2 times this year, as they're suggesting that they still will, that should be yet another factor that's going to weaken the U.S. dollar and be a tailwind for the multinationals. But I don't think the multinationals is the only way to play that. In fact, I still think there's some steam behind that international stock outperformance, which we can touch upon later.
We sure will. Meanwhile, let's bring in Josh Schaefer, of course. What is happening, Josh, Josh, with earnings anticipation in markets right now?
Yeah, Josh, so we had a couple large companies report today that we were focusing on. So you see Verizon here, that stock rising off of its earnings report. I'm looking at our trending ticker section of the Yahoo Finance website. You can also see Cleveland Cliffs is on there. That stock is up over 12%. But a trend, Josh, that I was talking about earlier, sort of off air, that I've been watching is just simply stock reaction. So you're seeing Cleveland Cliffs and Verizon are both up after their earnings releases. But when I flip to the year to date, it's been a little bit of a different story for these stocks, right? So you see Cleveland Cliffs here was actually down on the year entering this report essentially. Verizon also hadn't done that well. Now I want to flip to two stocks that reported last week that had been very hot this year and really hot over the last 2 years. So you take a look at Netflix. The 5-day on Netflix, that stock fell 5%, remember, last week after beating Wall Street's estimates on both sales and earnings, and then lifting its full year sales guidance. You flip over to, I'm going to take a quick look at JP Morgan, which has also been a very good stock in the financial sector over the past year. That 5-day chart, or we'll even go for a 10-day to get JPM's full earnings reaction in there. Yes, you've seen a little bit of a rally, but not a massive reaction. That stock had been up over 40% over the past year. So Kevin, I guess what I'm curious with here, when you look at just the different reactions we got and maybe the lack of a bid that a big tech stock like Netflix gets, I mean, is there any sort of read into where we're at with the market at record highs and if tech can kind of keep leading this market, or is the expectation at this point maybe too high for some of the big tech companies?
Yeah, I might suggest that, in my view, it's been a good but not a great earnings season thus far. According to FactSet, year-over-year earnings growth for the S&P 500 index is around 5.6%. Good, but if that holds, that would mark the fifth slowest quarter, going all the way back to the fourth quarter of 2023. So yes, we're seeing earnings growth, but not as high as we saw previously. We do need tech to come to the plate and actually deliver some even stronger earnings results. We know how much of an impact tech has on the large stock indexes and also on household portfolios, since the technology sector is the most held sector across retail investors. So hopefully tech continues to come through. Everyone's going to be waiting to see what NVIDIA reports down the road. But for now, we have to dissect everything we're getting out of the tech sector. And I liked what I heard from Taiwan Semiconductor last week when they raised their full year forecast by 30%.
We're going to get more into that name, by the way, later in the show. Josh and Ben, meanwhile, thank you guys. Appreciate it. Joining us now is Mohit Mittal. He's Chief Investment Officer, Core Strategies at PIMCO. That firm has more than $2 trillion in assets under management. Mohit, it is great to see you on the show. Maybe start, Mohit, with what we were just talking about there. Trade tensions, tariffs, Mohit. We have August 1st. That is circled on our calendars. As investors, we're all waiting for it. I'm curious, Mohit, just to think about, how are you thinking through that deadline? As a CIO, what are you telling clients?
Yeah, thanks for having me, Josh. So I think the way we are thinking about it, even if we take a step back from that one immediate deadline, what we are observing is a broad, somewhat slowdown in the data. Add to it the incredible amount of uncertainty that is being created by these broad tariff policies, and those uncertainties are not going to go away on August 1st. Meaning that there might be some extensions, there might be some deals, but those uncertainties are here to stay. And what that means is that that uncertainty feeds into corporate sentiment, that uncertainty feeds into consumer sentiment, which means that as we go forward towards the end of the year or next year, growth continues to slow down towards, say, 1%. And then add to it the context around earnings expectations. So when you look at the earnings expectations for this year, they are in the high single digits, same for next year. So the balance of risk in our mind, given kind of these uncertainties, and in the context of expectations, which are quite optimistic, the balance of risk seems to be towards kind of under-delivering relative to expectations.
So is your point, Mohit, I'm just looking at the popular averages here, we are agreeing across the board again, Mohit. Is your point that you think investors are being a bit complacent here?
Absolutely. I think that's kind of the view here, that investors are being complacent in, say, for example, kind of the equity markets, even in lower quality segments of the credit markets, where valuations are near historic tights. And when we contrast that to higher quality fixed income, where investors can get, call it 6-ish% yield in a very, very high quality manner, that looks like a very attractive alternative in this kind of environment of elevated uncertainty and ongoing complacency.
Kevin, bring you in here as well. Mohit's point is well taken. To the extent, Kevin, I wonder whether you get nervous when Nobody else seems to be nervous.
Absolutely. And I think what we need to understand is that we're pretty far along this bull market run. Through the first 73 trading days of 2025, the S&P 500 was down 10.2%, the fifth worst start in history. Now we've seen a significant move higher since day 74. How much longer can that run last? So I would anticipate some more short-term bouts of volatility ahead, whether it's due to the lack of trade agreements being announced, perhaps tariffs being more severe than when we originally anticipated, or the Fed staying on pause for even longer than many are currently forecasting right now. That could all create more volatility, but I think each part of that volatility brings more investors back into the market.
Mohit, what do you say to those folks who come on the show and they're bulled up, they're more constructive? And honestly, Mohit, I think they basically tell me, listen, Josh, just don't overthink this. The reason the market's higher is because the fundamentals look good, solid earnings, solid economic data, and a Fed that seems to want to cut later in the year. What is your response to that?
Yeah, I think there's a lot of merit to that, and that certainly can hold that we can continue to see equity markets do well. We continue to see credit markets do well. But I think what is also interesting is that in the last, call it 15, 17 years post the GFC, generally buying the dip has always worked out. And I think many factors have been behind it, but one of the factors continues to be around kind of ongoing large fiscal deficits, as well as a strong monetary policy support through quantitative easings. Whenever there has been a big stress, you have seen both the fiscal authorities as well as monetary authorities come to the rescue. I think where we are, as we think about kind of
Tech came down.
we recognize that because of high debt to GDP for the U.S. federal government, we have some constraints at the fiscal level in order to be able to address the next crisis with larger fiscal deficits. Same thing, with the central bank. I think the QE would be somewhat less easier to do next time around, given the prior inflation or concerns around inflation that the prior QEs may have created. So in that context, we recognize that I think certainly you could have an environment where earnings continue to deliver and equities do well, but the balance of risk seems to have shifted to the downside. And I think the last point I would highlight also is that a lot of optimism is being built around the idea that we will realize the productivity enhancements because of all the investments in AI-related chips, energy, all of that. In a scenario we don't realize those productivity enhancements, I think certainly the balance of risk, again, shifts a little bit to the downside.
You mentioned those monetary authorities, Mohit. When it comes to the Fed, where is the Fed in your story? How many cuts do you expect this year? Does the economy require a cut?
I think in our view, as I was mentioning, kind of some slowdown is happening in the data. I think 1-ish% growth for this year. And in that environment, central bank likely can deliver up to 2 cuts this year. Certainly, they are in no rush to cut, but starting September, maybe a couple of cuts for this year, and then maybe another 2 to 4 cuts next year. But should there be a little more slowdown, there is plenty of room to cut much more than currently priced in, with Fed funds rate at 4.5%.
Let me get your thoughts on the benchmark 10-year, Mohit. It's back to 4.37 here. Where does it head from here, near intermediate term?
So we have shifted in our portfolio somewhat overweight bias towards interest rate risk, meaning that we think over the medium term, the balance of risk is towards lower rates than higher rates. That does not mean that 10-year cannot go somewhat higher than here. But if we take a little bit of a longer horizon, 1 to 3 year horizon, we think over the next 1 to 3 years, 10-year likely heads lower from here, given the growth and the inflation backdrop.
Mohit, great to have you on the show today. Thanks so much for your time.
Thank you for having me.
We are just getting started here on Market Domination. Coming up, Trump Media, that stock surging after acquiring $2 billion worth of Bitcoin. We'll discuss the impact of the move in the 4 p.m. hour. Plus Tesla earnings, they're on tap this week. We're going to hear from an expert to preview what to watch from Elon Musk and the EV makers. Stick around, much more Market Domination still to come.
We got 45 minutes left in the market. New 15-minute candles opening up here.
Are you ready to master the markets and, dare I say, become a better investor in the process? Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor picking up new trends or you're just starting your financial journey, we offer invaluable market insights and strategies from some of the most influential minds on Wall Street and the boardroom. We're also teaming with some of the biggest rising stars in the financial community for key insights to help boost your portfolio, build your wealth, and make you a successful investor. Welcome to the Opening Bid Unfiltered podcast.
Welcome to Stocks in Translation.
Welcome to Financial Freestyle.
Welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk.
Welcome to the big idea.
Welcome to Yahoo Finance Sports Report.
Welcome to Where Your Money.
From Wall Street to Main Street to the C-suite, we're your daily lifeline. Because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, your favorite streaming platform, and wherever you get your podcasts.
Now time for some of today's trending tickers. We are watching Verizon, Domino's, and Dollar Tree. We're going to start here with Verizon, which is seeing its shares skyrocket after topping earnings expectations for the second quarter and raising its outlook on the low end of its full-year earnings guidance. So this one seems in print, Kevin. So post-second quarter revenue, that looks like it beat, did raise the profit outlook. The performance, and I thought this was interesting too, Verizon did call out what they call the favorable tax reform. That was in part what seems like it led them to raise some full-year guidance metrics. CEO saying Verizon has momentum and clear path forward. What do you make of it?
All good news for investors of the stock, for certainly. I would love to hear a dividend increase, but maybe that's coming down the road. But it's a very competitive field being in that communication services sector right now. And Verizon continues to put out new programs to try and lure new investors, both on the retail side and on the business side. And everything they're doing right now seems to be working.
All right, let's stick with the consumer because here's another one. Domino's reporting its second quarter results, sharing massive same-store sales growth while stagnating on revenues. Shares lower today. So this one, U.S. same-store sales rising. It looks like more than estimated. Did maintain the full-year comparable sales guidance. They did, it looks like, Kevin, talk a bit about the economy, the global economy there as a reason. Apparently, here's one, the launch of its Parmesan stuffed crust pizza. I haven't tried it, but that, they said, attracted new customers. What do you make of the results?
I mean, they beat on U.S. sales for the first time in 5 quarters. That's attractive. I haven't had a Domino's pizza since the junior year of college.
Well,
I don't know if the recipe
You live in New Jersey, where there's just too many good options.
Pizza. You don't put Parmesan in the crust. Just leave it as is, thin and crusty. But apparently someone is buying them.
Yes, right. What do you make? I mean, here's a general take. You think Domino's, kind of broader view in the consumer, what do you make so far of what you're hearing from the consumer?
Yeah, I think what we're learning from both Domino's and Dollar Tree is right now consumers are being a little bit more frugal. I think that's going to trickle through into the consumer staples sector as well. According to the Federal Reserve, the economy should slow to 1.4% this year. That benefits some of the smaller, more value-oriented brands like a Domino's, like a Dollar Tree.
Well, let's talk. Let me get your take on Dollar Tree. That was one I wanted your comment as well. There was some kind of bullish commentary on the street. Let me ping that off you. Barclays, for example, calls it a cleaner growth story now following what they're talking about, that Family Dollar sale. Some momentum they talk about observed in Q1, accelerating Q2, set up well for fiscal 25 and 26. Looks like they take their target is 120 over there. JP Morgan also, they raised the target, Kevin, to 138 on this work. 38. Fieldwork suggesting they told clients potential incremental upside driven by strength of the base business. The average target is around 100 here. Stock has enjoyed a nice run already.
Yeah, I mean, retail sales was up 0.6%, well beating estimates of 0.2%. But I think that's trickling through to these more value-oriented brands like a Dollar Tree right now. Consumer spending is so important, Josh, as we know, because it counts for 70% of economic growth. But look at where the spending is taking place. It's going to areas like Dollar Tree, like Domino's right now. And I think that's telling us something about where the economy may be going, at least in the eyes of the consumer right now.
Meanwhile, here's another name I'm going to want your take on, Kevin. Shares the drug manufacturer Sarepta. They're plunging. That's following 4 downgrades in a battle with the FDA now over the company's refusal to take a gene therapy drug off the market. With more on what this means, we have Yahoo Finance senior health reporter Anjali Kamlani. Anj.
That's right, Josh. As you mentioned, several downgrades for the company, and it is extending declines that started on Friday. That company was down about 35 to 40% on Friday alone. Over the weekend, it seems like it's been able to convince some investors and some analysts that it is making the right move, but we will have to see how this basically all plays out in its standoff with the FDA. Sarepta basically not disclosing a patient death in a clinical trial that it is actually ending as part of restructuring that the company announced after Q2 earnings last week. Once the report of the patient death came out, lots of questions about why it was not disclosed came up, as well as faith in management sort of shaken. Analysts talking about the idea that the company has not been forthcoming with the information, as well as trying to play it off. Then there's the FDA asking the company to take its current drug on the market, that's Elvidis, an unrelated drug, but similar in its technology, essentially the delivery mechanism, as the one that was in clinical trials. And so there had already been 2 patient deaths earlier this year from that drug, Elvidis, and that is the reason why the FDA asked for, or requested rather, the company to halt shipments. Sarepta has refused to do so, saying that there is no clinical reason for doing so, and so that standoff is where things are. Analysts are waiting to see how Sarepta handles this and what this could mean for the future of Elvidis. That drug alone in Q2 brought in more than half of revenues for the company. So it's a very big pot of revenue we're talking about and could impact Q3 and beyond, including for the next year, what those projections look like. So things are really shaky for this company right now.
Anj, let me ask you, is this just a Sarepta story? Is it just a narrow Sarepta issue, or is it potentially a broader gene therapy treatment issue?
This specific level of back and forth with the FDA and sort of concern is a Sarepta issue. They have been one that has been sort of watched very closely because of how they've handled these issues in the past. But gene therapy broadly has been suffering. There have been a lot of setbacks in that area, and so you have seen companies fall out over the recent past.
Kevin, your thoughts on this one?
I mean, gene editing, gene splicing is really the future of healthcare innovation right now. And I think the Sarepta story should serve as a reminder to investors to not just try and pick 1 or 2 biotech stocks, but rather build a diversified portfolio of small cap biotech stocks that are in different areas that large cap pharmaceutical companies may be interested in acquiring. Sarepta, obviously, is having some difficulties right now, to say the least. But that doesn't mean there aren't other companies that could step in and now look more attractive to large cap pharmaceuticals who want to add a gene editing type of company to their pipeline of products. So I think this just, once again, just serves as a reminder to investors to build a portfolio of biotech stocks, not just try and pick a one-hit wonder, be diversified and not concentrate your holdings.
Does that mean, Kevin, I want to pick an ETF? Is that the vehicle I should be looking at?
I think an ETF, a mutual fund. At Smart Trust, we have our own portfolio where we look for those companies that have at least 1 drug in FDA level 2 or level 3 approval status, that have a drug trial coming up in the next year, and that are in areas that we believe large cap pharma would be attractive.
All right, Anj, thank you. Appreciate it. Coming up, Tesla earnings, they're on tap this week. We're going to hear from an expert on the other side to preview what to watch from Elon Musk and the EV makers. Stick around, much more market domination. That's what we're done.
Now into the last 30 minutes of Power Hour here. Let's see where we close. New 15-minute candle.
Well, Tesla reporting second quarter earnings after the markets close on Wednesday. In one area investors will be, of course, keeping a close eye on. That would be the company's outlook as President Trump's big, beautiful bill phases out energy tax credits. For more, we're bringing in Jed Dorsheimer, group head of the Energy and Sustainability Research Sector at William Blair. Jed, it is good to see you, my friend. I think, Jed, correct me if I'm wrong, this is the first time I think I've spoken to you, Jed, since you did downgrade Tesla. You went to the equivalent of a hold, Jed. I think you did that a couple of weeks ago, earlier this month. Maybe start there, Jed. Walk us through why that downgrade.
Yeah, Josh, thank you for having me back. And it is the first time I think we've spoken since the downgrade. I don't think the big beautiful bill is going to be beautiful for Tesla. That's kind of the heart of it. I mean, I've had a positive bias on Tesla for a long time over my career, which has benefited, which has worked out quite well. But I think there's some challenges, and I don't think those will manifest this quarter or even next quarter. In fact, if anything, I think you could actually get some upside this quarter and next quarter as you pull in deliveries before the expiration of the tax credit. But there are challenges, and I think the challenges are going to show up primarily in the auto side of the business, but also a little bit in energy side, two different things going on there, and in the profitability. And that's why we downgraded the stock. We would prefer a lower entry point.
And when I talked to you, Jed, correct me if I'm misremembering, but your thesis, I mean, your reason that you were constructive on this name, it was the energy story, correct, Jed?
Energy, and then also, I think a lot of people are looking at robo-taxi and the future, the potential. Right now, I would say that, Tesla has been a stock that has transitioned, the valuation has moved from a lot of their core business to the things that they're going to do. But energy was our primary focus.
In the core business, Jed, I just spoke to another analyst, smart guy like yourself. He is more constructive on the name, and I talked to him about that core EV business. And in broad strokes, he was more optimistic, and I asked him why, and he said, well, it's that Model Y revamp, it's that new affordable model on the way. Your reaction to that argument?
I think those are all fair. The longer wheelbase in China on the Model Y, those could provide areas of relief. But across the board, all of the models are going to get $7,500 more expensive. And you have $2.8 billion of tax credits, which are pure margin. Those are the structural challenges that investors are going to have to wrestle with. And neither of those are going to show up this quarter or the next quarter. So quite frankly, I think if you're a trader and you're looking at the very near term, you could actually get, a little bit of upside here. But my job as a fundamental analyst to try and look at what's happening over the next 1 to 2 years or sometimes even longer, these are going to be challenges to the business until robo-taxi or humanoid robots, until those business units become a larger, more material part of the of Tesla's P&L.
If we're aware of these challenges, though, Jed, Musk is aware of them. So what are the levers he's going to pull to navigate these dynamics?
I mean, I think you're seeing some of that in terms of change of personnel. And, I would suspect that, they're not going to allow the vehicles. So I think they're going to push really hard. And I think Elon's getting back into, the position he probably feels most comfortable in. He is a great operator and leader, and I think he's going to push hard now that his focus is squarely on Tesla.
Musk is now saying, listen, he's back, he's committed. There were, of course, investors who were getting kind of nervous there, Jed, I think, when he was talking so much about forming this new political party, questions, understandably, about his focus, his attention. Were you getting questions about that from your clients?
We got a couple, but I would agree with his statements. I do think that Elon is back and focused on the business. If we did not have the structural challenges to the subsidies and the zero tax credits expiring, I would be taking a more constructive stance on this discussion with you. So I'm hopeful that he's going to be able to mitigate some of these things, and that we'll be able to become more constructive on the name.
When you are thinking about that robo-taxi service, Jed, how quickly do you think Musk can reasonably expand that service?
I think that's going to, we don't have it materially impacting our model until 28. So I think it'll be a challenge to pull it in much faster than that. And
what Jed, would you say are his competitive advantages as he takes on Waymo there?
Well, the competitive advantage is that he's, like most things that Elon does, is that they're taking a vertical integrated approach where Waymo is partnering with Uber. There's pros and cons of that. If Tesla can get this to work and they have a fundamentally lower cost structure compared to Waymo because they're using vision, so their tech stack is going to be cheaper, then they can weaponize price and take market share. And that could, result in faster growth or a more profitable business model compared to the Waymo-Uber partnership.
Question, Jed, final question for you. So you go down the equivalent of a hold. I'm sure you got questions from your clients, Jed, about, listen, what are the, Jed, upside risks I need to think about to this decision? What'd you tell them?
Upside in terms of, what's going to cause it to, well, I think the upside here would be, we already have the delivery numbers, so we need to look at what the profitability is. Some of the things we're talking about are further out, so you probably get a little upside on the margin profile. And then next quarter, you're not going to get hit with, you're not going to get hit with a gap in deliveries. And you also have that refresh and longer wheelbase. So those are some of the upside opportunities. Now, the downside opportunities would be that you could create a bit of a vacuum as you pull forward demand, knowing ahead of time that these cuts are going to occur. So you could actually get a larger delivery number for next quarter that leaves you with a weaker Q4. That's probably the downside risk. So it really is a little bit balanced here.
Jed, always great to see you and to have you on the show. Thank you, sir.
Yeah, thanks for having me back.
Kevin, your thoughts on all things Tesla?
Yeah, I think prior to the last year, I viewed Elon Musk as being the P.T. Barnum of electric vehicles. And then all of a sudden, he ventured into the political stratosphere, if you will, and brought Tesla along with it. But now he's back at Tesla again. And I just wonder if investors are viewing the Tesla investment opportunities under the wrong lens, viewing it as a pure electric vehicle company that's going to be impacted by these tax credits. I'd make the argument, Josh, that 2-3 years out, we're going to be looking at Tesla as a robotics company, much less of an EV company, and there's going to be even more opportunities for growth as a result of the play that they have in robotics.
Well, you bring up a good point, which is that the interesting thing about Tesla and earnings is that there is some not insignificant number of Tesla investors, Tesla shareholders, and they're in it, I think, Kevin, because they're believers in Musk.
Absolutely.
And they're believers in his vision.
Yes.
And to some extent, I think they almost look through the numbers because they think, hey, Musk is right. The future is autonomy, it's robots, that's the future, and Tesla's going to have a big share of that.
And that is what the future is going to be, autonomy, robotics. We're seeing that through the AI revolution. Tesla now is becoming not a backdoor play into the AI revolution, but investors have to be patient. It's going to take some time for Tesla to get there. They haven't even fully gotten there and become fully profitable on the EV side just yet, and now there's more challenges for Tesla on the EV side. But if you start looking at them through the lens of robotics and everything that Elon's going to now do to make them innovative in that field, I think they're going to be pretty
That is
excited.
the bold case. All right, thank you, Kevin. Appreciate it. Coming up, Google and Intel among the major players reporting earnings this week. Going to preview the numbers and get you set for everything you need to watch for from the results. Stick around. Much more market domination. Still to come.
Are you ready to master the markets?
Going into the
and, dare I
last
say,
5
become a
minutes
better
of
investor in the
this,
process?
these 15-minute
Yahoo Finance
candles
has you
we're
covered
watching,
with
and
our
then
new
that'll
full
leave
suite
us
of
with
original
15 till
podcast content.
close.
Whether you're a seasoned investor picking up new trends or you're just starting your financial journey, we offer invaluable market insights and strategies from some of the most influential minds on Wall Street and the boardroom. We're also teaming with some of the biggest rising stars in the financial community for key insights to help boost your portfolio, build your wealth, and make you a successful investor. Welcome to the Opening Bid Unfiltered podcast.
Welcome to Stocks in Translation.
Welcome to Financial Freestyle.
Welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk.
Welcome to the big idea.
Welcome to Yahoo Finance Sports Report.
Welcome to Where Your Money.
From Wall Street to Main Street to the C-suite, we're your daily lifeline. Because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, your favorite streaming platform, and wherever you get your podcasts.
And IWM small caps just keeps bleeding. Let's see if it drags down the rest of the market with it here. Two more minutes left on these 15-minute candles we're watching. A minute and a half.
Big tech earnings on deck with Alphabet reporting second quarter earnings on Wednesday and Intel on Thursday. For more, we are bringing in Yahoo Finance tech editor Dan Howley. Dan.
Yeah, Josh, we're looking at obviously Alphabet, Google's parent company, coming in first. As you said on Wednesday, there's really a lot of conversation as to, if they're going to keep up that AI spending and what they're seeing as far as Google Cloud adoption. But let's just go over some of the numbers real quick.
Going
For the
into
quarter,
the
we're expecting to see
last
adjusted earnings
20
per share
seconds. Order filled.
$2.17. That's on revenue ex-TAC, which is traffic acquisition cost, the amount they pay companies like Apple, et cetera, to get traffic acquisition, of $79.6 billion. That's an 11.6% jump versus the same period last year. And what we're looking at as far as advertising revenue is expected to be $69.6 billion, up 7.7%. But really, it's the Google Cloud Platform that I think everyone's mostly interested as far as potential growth. And there, we're expecting to see 26% increase year over year to 13.1%. The cloud operating income should come in at 2.2%. That's a 91% year-over-year increase, but it's not as high as we've seen in prior periods. So really interesting there. Obviously, the big to-do with Google continues to be the Gemini rollout that it's doing across its various products, whether that's on the consumer side or the enterprise side, with workspaces and cloud being kind of their future growth engine or current growth engine, whether or not it's able to catch up to the likes of Microsoft and Amazon. But one of the things worth keeping in mind is, well, if they do have a good quarter, that's all good, great, and grand. But next month, we're expected to hear the results of the remedies trial that the company was going through with the DOJ and the department's antitrust case against them. And part of that could mean forcing Google to sell off its Chrome browser. Another could be forcing it to abandon agreements like it has with Apple or Samsung that see those companies use Google Search as their primary search engine. So, a lot coming down the pike for Google in just the next few weeks. And then outside of Google, the following day on Thursday, we have Intel. This is kind of
order rejected.
Bigger than the results kind of question. We're expecting potentially to hear anything from new CEO Lip-Bu Tan on what they're doing with regards to the kind of turnaround effort there. There have been reports that perhaps Intel will abandon 18A as far as offering that technology as a chip fabrication technology for third-party customers. They would still use it internally, but they would focus more on their upcoming 14A. That's their next generation after 18A chip technology to better compete with TSMC. The Oregonian has done a lot of good reporting on some of the layoffs there. They've reported that they're shutting down their automotive business, that they're seeing layoffs or moving to outsourcing for their marketing department and doing some layoffs at its factory. So, a lot of cost-cutting measures here, as well as potential moves for that technology that they have for the fabrication technology. For the quarter, look, we're expecting to see earnings per share of 1 cent. That's adjusted EPS of 1 cent on revenue of $11.8 billion. That would be down from 2 cents in the same quarter last year, and revenue of $12.8 billion. One of the things to look out for is the potential pull forward of CPUs as far as desktops and laptops and data centers go.
Tech
with regards
is
to tariffs,
about
because there was,
0.5% from going red.
Impact sales of chips
SPY
or
is
devices. So
only
you may have seen some pull forward, and that
so
could
about
benefit
$1 away from
the
red.
product side of things. But again, it seems as though the bigger question is, what does this turnaround look like under Tan, and will they continue to use 18A as a third-party product, or will they just keep it internal?
Kevin, your big thoughts on big tech earnings?
Yeah, I would suggest that so far this year, the Magnificent Seven has become the somewhat still Magnificent Three. Those three, of course, being NVIDIA, Microsoft, and Meta. Of those three, I'm really anxious to hear what NVIDIA reports. We have to wait a little bit on that front, but last quarter we saw that 88% of their revenues were attributed to data centers, while just 12% to GPUs. That's important because they're diversifying out their revenue stream, and it's also a reminder that they sit at the hub of the overall AI ecosystem. So the AI revolution is alive and well. It's a long road, and people need to be patient with the technology sector when you invest in that type of sector that has that much volatility.
All right, speaking of all things tech, we're also taking a look at the chip sector. The AI trade remains intact, but heading into earnings, inventory, and tariffs, we know they're top of mind for investors. For more, we want to welcome in here John Vinn, equity research analyst at KeyBanc Capital Markets. John, great to see you as always. Maybe start there, John, just sort of higher level. You think of that mega AI trade and trend, John, and certainly the names chip investors want to play that. So the NVIDIAs, the Broadcoms. There was some questions about that, John, not too long ago, but now you look at it and it certainly looks resilient, or at least that's how investors are betting on it. But what do you see, John?
Yeah, I would agree with that. I think the AI chip sector remains broadly very resilient. I think there's very strong,
I
robust
think this is
demand across the
probably the low.
board. And then with
I
the
mean, we only got
recent
we're going
news
into
that the
10 minutes,
U.S.
so I think
administration
the
now
last 10
has
minutes we'll
lifted
try to
the AI
balance,
chip
but I don't
ban
think we go
on
very
chips to
far.
China, companies.
If you're taking a look at SPY, maybe a bounce back up to 629.50 ish. If we're taking a look at Qs, bounce back up to around 564.75 or 565 area. IWM's been the weakest, so I don't know. I think it just comes back up around here to the moving average, right around 222.
Between them and the competition. And then Broadcom, we also think is really well positioned in the AI chip space. I think thematically, how we think about it is Broadcom is kind of the leader in the custom AI silicon space, right? Their largest customer, Google TPU, by far
There you
has
go,
one of the
getting
most
that slight
successful
that
custom AI chip
could have
solution in the
caught that.
sector, and then they're starting to ramp in the second
Well,
half
we'll
here.
just hang out.
Meta with their MTIA AI chip, which also should be an incremental tailwind.
What about, John, export controls and tariffs? You know, those are sort of moving targets here. How should we be thinking through those dynamics as investors?
I think what you're going to see in the near to medium term, right, because these policies change and are quite dynamic, that I think investors are going to want to understand what the incremental benefit and tailwind related to China shipments are. And I think in the near and medium term, until we get better visibility in terms of what the long-term policy and geopolitical situation with the U.S. and China is, I don't think that people are going to bank on those China revenues longer term, right? But I think in the near term, you're going to hear NVIDIA talk about what its total AI revenues are. I think you're also going to get questions, and you're going to get them to ultimately back out what the China contribution is. And I think people are going to keep tabs of that until we get better certainty in terms of the relationships between U.S. and China.
I also, John, I want your thoughts on Intel, earnings on deck. I know you got the equivalent, John, of a hold on that one. How come?
Yeah,
I think they've just got too many challenges.
Trying, but struggling a little bit.
Is going to be a very
Intel right now.
long path ahead for them, right? It's going to be several years before they get meaningful revenues. And on the core IDM business, they're under attack on multiple fronts, right? They're losing share to AMD on servers. They're losing share on client PCs to ARM. And they don't have a credible AI strategy at this point. So obviously they're huge laggards to the rest of the AI chip sector.
You mentioned AMD there, John, which has had a nice run, about 30% this year, but I know you've got the equivalent of a hold on that one as well.
Yeah, we are sector weight on AMD. Just some concerns about their ability to sustain and compete against NVIDIA longer term. But I would say the near-term setup for AMD looks really good. They are ramping their new GPU, the MI355. We think demand is looking extremely robust. We think they're probably on track to do $7 billion in AI revenues this year. Server CPU, they just launched their latest generation chip, Turin. It's gaining share at Google Cloud. It's ramping quite nicely. And then on the PC space, they're
trying to push,
against Intel there. And I think
these
the near-term setup
up everything
for
for
AMD looks very, very robust to us.
I mean,
John,
new
always
highs
appreciate
and
your
just
time in those
right
picks.
back
Thank
to
you.
the break.
Great. Thank you, Josh.
Dan, Kevin, want to bring you guys back here as well. Kevin, you were listening there. We were talking about that mega sort of AI
Something I
trade and
invite
trend.
you all to do is take a look
intact right now,
at
but what are your
how
thoughts?
much
I think
it's
people need
up
to recognize
already
that the
based
AI
off of.
revolution is a long road,
I'm talking about
and it's filled
SPY,
with many potholes.
based off of its
Ultimately, there's
typical
going to be many
movement
different
during the
winners. I think
summer,
Microsoft may be the ultimate
especially
winner,
in the month
but they're
of
not going to
July.
be the only winner. and there's likely to be even more losers. So you have to look at the whole ecosystem for opportunities. The software plays, the hardware plays, the chip plays, the data center plays, the power solutions plays. And I think that's how investors can better navigate the AI revolution going forward, not just concentrating in any one name or one particular component, such as chips, within the ecosystem.
And Dan, it wasn't so long ago. I know there were worries. We were talking about the NVIDIAs, and there were some concerns. It was DeepSeek. There were concerns about maybe 2025 was representing some high watermark, Dan, in terms of AI CapEx spend. But right now, it seems like investors are willing to bet that that's not true and that the trend remains
Here we go.
intact.
Last 5
Yeah, I mean, look,
minutes of
Google said
market.
in their prior earnings release that they were still on track to spend $75 billion this year for building out their CapEx. They also said that they were still capacity constrained in the prior quarter, in the current quarter. So look, they're going to continue to build out. Microsoft's going to continue to build out. The entire issue with DeepSeek was about training. And so then the kind of thesis became, okay, well, these models benefit from high-powered chips like NVIDIA's when it comes to inferencing or actually using them. And so that's been beneficial to NVIDIA as well as the broader AI trade. I think the bigger thing is going to be, not necessarily on the chip side, but on the software side. And, when Microsoft and Google and Amazon really start to see revenue ramp up from their AI services. On the chip side, look, yeah, it's basically just NVIDIA, Broadcom benefiting.
And it would be the
handsomely.
first
Then you have,
time,
the
or the
hyperscalers
first,
that have their own chips,
yeah, the
but
first
NVIDIA's
time
still
we
going to be in there.
make a new low of
AMD
day
to
in the
a smaller degree, and Intel,
in
basically
the
just
past,
kind of
2 weeks.
floating around with the CPU side of things.
Every day we've had a
It'll be
bounce
interesting
at
to
the
see what
last
happens
5
down the
to
line,
15 minutes.
years and years down the line, when some of its biggest customers maybe tail off a little bit, or we have to just see what happens. Because,
Now that downside is
in its
being
most
led by
recent
tech.
earnings,
You see
NVIDIA said
IWM
that,
trying to
I think it was
hold.
just slightly less than 50% of its revenue comes from those hyperscalers. And so there's that heavy concentration of revenue coming in from those sources. What happens down the line, we just have to see.
Dan, thank you, sir. Appreciate it. While we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the
That's
action. Follow the
true.
closing bell. Stay tuned for
Around
market
this time of
domination
year
overtime.
in the past, there has been a run-up. So right now we're trying to figure out what exactly is fair value across the market, right? Because yes, we've had run-ups in the past, but we also have an average move on SPY at least of around 1% or so, and it's already reached that. So right now it's kind of battling that average move, and do we outperform that? What do we see? And a lot of it's going to be driven by these earnings, right, that we see as we head into the app earnings. Like we have Google, we have tomorrow, if I'm not mistaken, American Airlines on Thursday, Intel on Thursday, Southwest. So we start to get into these big tech companies, the travels, things along those lines. So things to keep an eye on. Yeah, I've been liking its strength. Let's go ahead and bring up that chart here. There we go. I'm liking where it's at least the ability or the willingness to hold here. If you can tell, at least on the moving averages, what it's doing now, it's being squeezed right between the 5 moving average and the 60-day moving average. So this green one here, it holds a lot more weight, right? So right now what we're seeing is the moving average is starting to curl and stack up on each other. Ultimately, the what we want to reach out for like an official breakout and where the rest of the market will start to flow into it themselves, and we're last minute of market here, is when we hit and break the 120-day moving average, right? But we're in fairly early, which is what makes me feel comfortable with the amount of time we have. So we just really, I want to see it above 20, right? Or I mean 24 is the mark that we've been talking about consistently, and that also happens to just be right where the 60-day exponential moving average sits at. So it's something big to keep an eye on. There we go. Market has closed. We did make a new low of day here on that last 5-minute candle.
That's what bell on Wall Street, and
Pretty
now
different
it's market
comparison
domination
to
over time. We're
what we
giving
had been experiencing. Taking a look back, let me bring up Intel again. I like where it held. I don't like how we keep getting these types of days, right? Where we open up strong and we're flirting with that break, and then we just get smacked back down. But as long as we can stay within this area, I'm going to continue to feel comfortable holding it. I did end up picking up one of my other Intel contracts for the new options account, which is the $30 strike for January, to give myself a little bit more time on that specific account. So I'm still confident in this move, but we do want to see it hold above 23 for sure. But we need the break of 24 with the consolidation above it. I don't know that it'll move super quickly, but the more that we're able to build between that 24 to 25 dollar range, the better it'll look like going into the next month or so. Ideally, if we're able to do that by like mid August, then that's what makes me feel a lot more comfortable with that potential push into like the 27, 28 dollar range by September. Cool. And that's where we're going to call it a day here. Market has closed, but I'll be in the group giving a little bit more information down as far as what my plan is and what I'm hoping to do the next couple of days. I didn't really trade the funded accounts today. I don't know how much availability I'll have in the next week or so to trade them, and I don't want to push myself too much with them. So just being patient with it. Hope you all enjoy the rest of your day.